Hi, can you guys hear me?
Yes, sir.
Should I start now or shall we wait for a couple of minutes? I cannot hear you. You are muted.
Good evening, sir. I would first like to provide a brief introduction to our participants, then we can start.
Sure, sure.
So, good evening, participants. Myself, Spandan Satpathy. I welcome you all on behalf of the Quant Club of Society of Finance, Economics and Business, IIT Bhubaneswar, to this informative webinar. FEF stands as a cornerstone of academic excellence within our institution, dedicated to fostering knowledge exchange and exploration in finance, business, and economics. Through our collaborative efforts, we aim to nurture a vibrant community of quant enthusiasts across India. It is our distinct honor to introduce Mr. Rishabh Gupta, a PhD candidate of Purdue University in quantum computing and information. He has published 10 research papers in peer-reviewed journals and has over 100 citations to his name. Being an experienced quant researcher and as the co-founder of Finovix Algo Trading Solutions, Mr. Gupta brings a wealth of expertise and insight to our webinar today. With a focus on GBM, ECGBM, and how log normal assumption reduces the efficacy of pricing models. Without further ado, let's begin the session. Mr. Gupta, over to you.
Thanks, Spandan, for inviting me and for the kind introduction. I'll share my screen and then we can start. Can you guys see my screen?
Yes, sir.
Okay. So this is like I would like this session to be quite informal. So you are free to ask me any questions. Maybe we can do this in the end, or maybe during the presentation if something is not clear to you guys. Then also you can stop me, or maybe Spandan can just communicate your questions. So as Spandan pointed out that since I'm pursuing PhD, I've also been interested in quant finance and specifically algo trading right from the first year of my PhD. And this is predominantly why like I could also apply the learnings that I used in my research projects at Purdue to my own personal venture where I'm trying to build algo trading models for live trading. So while I was doing my research, my primary focus was and is on entropy, which has been there for over 150 years. So entropy was introduced, I guess, in 1860s, and but specifically it was in thermodynamics and geometric Brownian motion. Since you are also like quant finance enthusiast, you must be aware that how heavily this model is applied in a variety of fields within finance. So what I saw, like there was some gap within the geometric Brownian motion, which is like an assumption, which I am going to address through the use of entropy. So again, this is the content of my talk, where since I assume like since most of you may not be familiar with what is entropy or maybe like geometric Brownian motion. So I'm also going to go step by step with the introduction of like what is entropy, GBM, then how what was the motivation behind entropy corrected GBM, like how I could relate my research into this particular domain. Then I'm going to discuss the methodology and some of the applications, which I've also shown in the paper that I posted. And in the end, I am going to also conclude this talk with a brief introduction about how this method can be valuable in the banking sector as well by estimation of value at risk. So let's get started with some definition of entropy and how it is related to randomness. Entropy. So the first few slides would be slightly theoretical, where I am just introducing the concept. So just bear with me. And then in the later, like 60-70% of the talk, I'll have more results and everything. I'll explain it fully. So entropy as a concept has been there for quite some time, and it has been used in a variety of different fields, be it ranging in physics like thermodynamics or information entropy, information theory, or even now in machine learning as well. Entropy is heavily used. So, but one of the common factors in all of these, like different field, is entropy is a measure of some kind of a disorder or randomness within a system. So if you consider thermodynamics, like in statistical physics, we have different configurations of atoms, molecules, or ions, right? And each of these microscopic configurations are governed by macroscopic properties like temperature, pressure, and volume. So entropy basically gives you an estimate of how many possible microscopic configurations that system can have within a certain macroscopic property. Okay. Now in thermodynamics, we also have something called equilibrium and non-equilibrium. So it is worth pointing out that entropy of a closed system tend to increase over time. Let me use some highlighter. Yeah. So entropy tends to increase over time, which essentially means that the system is going towards equilibrium. And at equilibrium, the entropy is maximum. So now, again, in information theory, you must have heard about Shannon entropy is there. So which quantifies how what is the disorder within a random variable. Okay, like in communications, you also use encryptions, right? The coding is there, bit coding is there. Everything that you have there, you quantify the uncertainty of a random variable using entropy. For example, if you have a probability distribution or some configuration which is uniform. For example, let's say you have a bias, if you have an unbiased dice roll, okay, you roll it 10,000 times or 50,000 times. If it is unbiased, you'll get a probability distribution which is going to be uniform, which essentially gives you very little information. Okay. Now, if the information is low, just keep in mind that the entropy is going to be high. It's that simple. And also in machine learning, cross entropy is basically used to find out the difference between two probability distributions. So if you have two probability distributions, one is, let's say, a true distribution, and then other is some machine learning algorithm that you are using to generate a probability distribution which is close to the true distribution, then cross entropy can be used. So it also serves as a loss function in various machine learning algorithms, especially, let's say, in classification tasks and all. So entropy has found its way in a variety of different fields. And since for my PhD research, I have also been exploring the use of entropy in quantum information. So that's how I could basically bridge this academic research into quant finance. So also, I would like to give a brief intro about geometric Brownian motion. Geometric Brownian motion is nothing but a stochastic process that describes the evolution of a system in a probabilistic manner. Okay, stochastic processes are very common, like in finance, physics, biology, everywhere it's quite common. But geometric Brownian motion is one type of stochastic process that is very heavily used in finance, particularly for modeling stock prices, for forecasting stock prices, essentially. Okay. Within the geometric Brownian motion, you basically have to solve a stochastic differential equation, which is given by this particular equation. Okay. Within this equation, the S of t basically represents the future stock prices, or whatever asset price that you are trying to forecast. The mu and sigma are basically the drift term and the volatility term that is obtained from the historical distribution. So for example, if you have a Tesla stock price, for example, over the last, let's say, 1 year, okay, the mu would basically represent how is the average growth rate of a particular random variable is like how the random variable is growing over time. So how the Tesla stock price is going. So you just take the mean of that. That would give you the drift term. Volatility term basically represents the uncertainty in the growth rate. So how much away is the particular asset is from the mean. So that represents your volatility term. W is nothing but just a Wiener process. This Wiener process is, you can consider it as white noise. White noise is something that you sample from a normal distribution. Okay. So once all of these terms are clear, you can just solve for S of t. Okay. It's a closed form solution. So if you solve this differential equation, you are going to obtain the expression for geometric Brownian motion. So where S naught is the current stock price and S of t is for various time steps, you can obtain the future stock prices. So now I have explained what is mu, sigma, and what is the
Excuse me, sir.
process. Yeah, yeah.
Sir, I guess your slide is not changing, sir.
Oh, slide is not changing.
Yes, sir.
Let me see.
Yeah, now it is being said. Yeah.
Okay. Is it changing now?
Sir, we are on the geometric Brownian motion page number 7, sir.
Can you see the figures now?
No, sir. We are on the We are on the page 7,
Okay,
sir.
okay. I think okay, okay.
Yeah, now
Maybe
it is
there is
changing,
some
sir.
problem. Wait. When I'm actually going on to the full view, it's not changing. Let me try to share the screen. Can you see my screen now and
Yes,
can you
sir.
tell me if it
Yes,
is
sir.
changing? It's changing. Okay. So yeah, as I was explaining, uh, this is the equation of the geometric Brownian motion, where mu and sigma you can obtain from the historical distribution, and W is actually the Wiener process, which is nothing but just white noise, and that you can sample from a normal distribution according to whatever time step that you want. So one limitation, or not limitation, but a basic assumption of geometric Brownian motion is that the underlying probability distribution is log normal. Okay, I'm also going to show what a log normal distribution looks like. But this assumption, uh, like if you were in before the COVID period, okay, where the volatility of the markets weren't that high as you have seen in the last few years. Okay, last few years the volatility of the market is crazy. Even in the current form, high inflation, and then in the US, the Feds are trying to control inflation. So this has resulted in very high volatility in the market. So if you are considering some short-term time series, okay, since the market is changing so rapidly, the log normality assumption, in my opinion, is impractical. So there has been alternative ways to solve that, but the ease with which you can use geometric Brownian motion, it just imparts some level of simplicity to your model. So I thought, why not we can just try to make certain corrections to the geometric Brownian motion method itself, so that we can address this assumption where if the underlying probability distribution is not log normal, in that particular case, we can still use the simplistic model of geometric Brownian motion to forecast stock prices and use it in various fields that I'm also going to show you at the end. So if you consider the figure on the left, we have the green distribution is the log normal distribution. In the middle, we have this as the normal distribution. These curves basically represent the probability density function. If you consider a log normal distribution, and if you are using GBM to forecast your stock price, if I have this on the right hand side, the Tesla stock prices for the last 1 year, okay, up till March. So if I consider last 1 year of Tesla stock prices, you see this probability distribution is nowhere close to this log normal distribution, right? So now if I just consider log normality and I use my GBM to forecast my stock prices and I'm using it extensively for different purpose, then I am just going to fail in my estimate because the underlying distribution is nowhere close to log normal. So this is where I wanted to address the problem that, okay, if the underlying probability distribution is not log normal, can I still use GBM while also making sure that the trajectories that GBM forecast, those trajectories result in the underlying distribution, such as this Tesla's distribution. Okay. So now, what is entropy corrected geometric Brownian motion? To define that, I would like to also tell you like what motivated me to come up with this idea. Okay, so since you guys, most of you are from IT Bhubaneswar, okay, I wanted to stress that, okay, if you are quant enthusiast, you can apply the learnings from whatever you are researching within IIT or whatever research projects that you are under, you are learning. You can use those to basically come up with certain nuances within the already existing model. So this concept, the maximal entropy formalism, has been there for like 70 years. It was first introduced in the early 1950s, and I have been using the maximal entropy formalism in quantum information. Okay, so what is this maximal entropy formalism? So consider, let's say you have an unknown probability distribution, okay, of which you have just limited knowledge, like incomplete information you have. But what you can do is you can make measurements on that particular system. For example, let's say you have a biased coin, but you don't know what is the biasness. Okay, but what you can do with the coin is you can just do experiment of flipping the coin multiple times. Okay, let's say 100 times. So that way you can get one expectation value of what is the outcome. Okay, so maximal entropy formalism, what it tells you is you try to maximize the entropy. So this is the formula for entropy. If you have any probability distribution defined over some random variable x, okay, you have px log px, like negative of this is basically going to give you entropy. So you try to maximize this particular function subject to the constraints of the problem. Like the constraint that I defined in the coin flip was the expectation value of the outcome. Okay. Similarly, in a different setting, in a different system, different situation, you can have various functions whose expectation value is experimentally obtainable. Okay. So now, and theoretically, how you find the expectation value if you have a probability distribution, you can simply compute px times fx over all configurations of x. Okay. Once you get this, you can construct a Lagrangian in this fashion, and where you parameterized your constraints using some Lagrange multiplier. Okay. And this is unknown, these Lagrange multipliers are unknown, but since your objective is to maximize the entropy, you can simply take the derivative of this Lagrange multiplier, this Lagrangian with respect to the Lagrange multiplier and set it to 0, and you can obtain what will be your lambda. And once you do that, you will automatically have a closed form solution of the probability distribution. It is an exponential function. Okay. So this is like a little bit of maths, but even if you don't understand it, what you need to understand is the maximal entropy formalism gives you a least biased probability distribution that is consistent with the given constraints. I wanted to stress on this term least biased because this I am going to use it in the future. Okay, so Just keep in mind that maximal entropy formalism will give you the least biased probability distribution that is consistent with the given set of constraints. So how I use this motivation from the maximal entropy formalism to go from GBM to the entropy corrected GBM. So since I also stressed on the least biased part, right? Here, what is my objective? So my objective is for a given underlying probability distribution, which may not be log normal. Okay, like the example I showed you of Tesla's probability distribution in the last 1 year, which wasn't log normal. So for a given underlying probability distribution, I want to use GBM to forecast the trajectories, correct? But I know that GBM uses the log normality probability distribution. So whatever the GBM is forecasting the trajectories, whatever trajectories the GBM is forecasting, ultimately, if I'm going to plot those trajectories, it's going to form a log normal distribution. So my objective was, if in the maximal entropy formalism, I am getting the least bias distribution, can I go in the reverse direction where I use the trajectories from the probability, the GBM probability distribution in such a manner that I find the most biased probability distribution that is biased towards the underlying probability distribution. Okay. So I'll also iterate it once more before discussing the methodology. From maximal entropy formalism, we are obtaining the least bias probability distribution. Here, the objective is simply the reverse, where the distribution that I obtain from GBM trajectories, I want to filter those trajectories in such a manner that I obtain a distribution that is most biased towards the underlying probability distribution. So this is the simple thing that I am trying to do in this particular project. To explain that, let us again go back to the simple example of rolling a dice. Okay. If I have a fair dice, okay, there is no biasness into that dice. I can get the dice space 1, 2, 3, 4, 5, 6 with almost equal probabilities. In this particular case, if I try to calculate the entropy, since I know what is the probability of this, and every dice space, I can calculate what is going to be my entropy, and it is going to turn out to be like maximum for this particular dice roll. Okay, 2.58. For another system, it can be different, but since it is a uniform probability distribution, and in the beginning, I explained to you that uh, the lower the information that you get, higher is going to be the entropy. Okay. So how are we quantifying how much information do I have? Like if I give you an unbiased dice and I tell you, okay, which is going to be the next outcome, because you know for sure that the dice is unbiased, you cannot tell that what will be the outcome, because it is a uniform probability distribution from 1 to 6. And that's why, because you have some less information, the entropy is going to be very high. On the other case, if I increase the biasness of, let's say, the dice space 3, okay, if I give you a dice which has a higher bias towards one particular side of the dice, you see the entropy is decreased. If I calculate the entropy of this particular probability distribution, the entropy in the earlier case was 2.58, but in this particular case it is simply 2.40, which is lower than what entropy I got in the uniform distribution. Here the frequency of phase 3 is 3500. However, if I further increase the biasness of phase 3, okay, the frequency, if you see it's 5000, you see the entropy decrease is like there's further decrease in the entropy. Okay. So what I mean by increasing the biasness, uh, by increasing the biasness, what I'm telling you that phase site 3 is going to be more probable in the outcomes. So let's say I give you a dice which has a bias towards face site 3. Now you can bet on, okay, if I bet on site 3, probably in 10 outcomes, I'm going to earn more from betting on 3 rather than betting on the other faces. Okay. So this is how I can use entropy to quantify the level of determinism of an event to occur. Correct? Earlier, in earlier definitions of entropy, people used to define it as the level of uncertainty or randomness within the system, right? So I am just doing the reverse thing. If entropy can tell you your degree of randomness, on the other hand, it can also tell you the level of determinism if your entropy is decreasing. So this is what I exploited in this particular research. So before moving on to the methodology, do you have any questions? I'll stop for 30 seconds if you have any questions. Okay, so if you have no questions, then moving towards methodology. So how am I constructing the entropy corrected GBM distribution? So first of all, you need to have a reference data, which is the historical data. Again, you can consider, let's say, last 1 year of Tesla's stock price, like for each day. Okay. Based on that, you can compute what is your probability distribution. Okay. Once you have the probability distribution, as I showed you for the dice roll case, since you have all the different PI, like the probability for each bin in the histogram, you can calculate what is going to be your Shannon entropy. And entropy formula is nothing but summation of negative of PI, ln PI, which is also straightforward to calculate. Now, this is where the novelty is coming at this particular step. So let's say you have that underlying probability distribution from the historical data. Now I am using GBM to forecast a trajectory. For example, if I have 100 days of Tesla stock prices, I'm using GBM to forecast the next 30 days. Okay, I can get one trajectory because it is a stochastic process. I can do it in a Monte Carlo fashion to get thousands of trajectory. But let's say I am getting just one trajectory of the next 30 days. So for the initial 100 days, I have the historical probability distribution plotted. Okay. Now I am appending this trajectory to this reference data of 100 days. This 100 days is just an example. So I'm appending this trajectory to the reference data. And now I'm again, once I've appended this trajectory to the reference data, now I'm again plotting the probability distribution. Okay. Of course, the probability distribution is going to change. Maybe it can change slightly or it can change by a large amount depending on what's the distribution that is there in the underlying distribution. So I compute the modified probability distribution and I calculate the entropy of this modified distribution. Okay. Now, if this new entropy that I am calculating, if this is lower than the original entropy of the reference data, then I know that this trajectory is basically increasing the determinism within the probability distribution. Okay. You need to understand this part very clearly. So if I am appending this trajectory and the entropy goes down, for example, in this particular case of dice phase, okay, if I am adding more threes in the outcomes, if I'm increasing the frequency of this, I see that the determinism level of 3 is increasing further and the entropy is going down further. Same thing here also I am doing. I have a reference data. I have a GBM forecast trajectory. I'm appending it to the original reference data and looking at the change in the entropy. If the entropy change is significant, like have defined some particular threshold to basically set how much significant decrease I want. It is your user's choice, whatever they want to set depending on the problem. So if this entropy decrease is significant, I accept that trajectory. Okay. If this is not significant, I would reject this trajectory. And if my number of Monte Carlo simulations is less than the fixed threshold that I have, let's say 10,000 simulations, then I would again go back, again calculate like forecast a trajectory using GBM, again append it to the reference data and look at the entropy decrease. So I would just accept only those particular trajectories here whose entropy decrease is significant. Okay. So once I have all of those GBM trajectories that lead to a significant decrease in entropy, I would basically in the end compute my expectation value of all the trajectories or whatever problem that I'm trying to address. Okay. The reason I am choosing only those trajectories that lead to a decrease in entropy is because I know for a fact that if the entropy is decreasing, the trajectory that I am appending to the original distribution is basically increasing the deterministic content within the probability distribution. Like increasing this particular dice phase outcomes is going to decrease the entropy. So again, if the entropy is decreasing, I will accept that particular outcome. If the entropy is not decreasing, I am just going to ignore it and I'm just going to repeat this process however number of times that I want, depending on the accuracy of the Monte Carlo simulation. Okay. If this point is clear, then this is just a pictorial representation of the Monte Carlo simulation of geometric Brownian motion. Like you can get hundreds of trajectories or thousands of trajectories by just sampling the Wiener process. Like Wiener process is nothing but you sample from a normal distribution. Okay. You see in this equation, the mu is fixed, sigma is fixed, this t is time step is fixed. And so all of these things are fixed except for the Wiener process, which is just white noise. White noise is nothing but when you sample from a normal distribution, you get white noise. Okay. So if you have all of these things fixed except for the WT, like this basically imparts the stochasticity into the GBM model. Okay. So if you are sampling many times, the GBM trajectories can be will basically deviate from each other, and in the end you would have sampled from the entire log normal probability distribution. So here what I have plotted is like this green probability distribution is just the probability distribution that I am getting from these trajectories, GBM trajectories, which is log normal. Okay. But if your underlying distribution wasn't log normal, maybe it was normal distribution. Okay. In this particular case, you see, if you would have used the GBM distribution, okay, there is no way that it's going to give you a higher accuracy in the results or whatever property that you are trying to estimate. Okay. Because this log normal distribution would basically sample more from this region, right? And in this region, the normal distribution proportion is so little. So GBM would practically fail in this particular scenario. But if I consider the trajectories that were in this region, and I give more weightage to these particular trajectories that corresponded to the values in this particular region, the underlying EC-GBM, the entropy corrected GBM distribution, would basically be more accurate and fit in a better manner to the reference distribution. So this is like the biggest advantage of the entropy corrected GBM over the traditional GBM that has been there for like many years. Okay. Again, why this is important? Because of the high volatility within the market, this particular traditional GBM approach wouldn't be that accurate, but we need to enhance the accuracy of either you replace the GBM or maybe ECGBM can be a very good alternative for like forecasting stock prices. So as a proof of concept, I used a time series of a biased dice roll. What I mean by a time series of biased dice roll is, let's say I roll the dice 50 times, okay, in this particular case. And the dice, since the dice roll is biased, I get this probability distribution. So I noted down whatever values I was getting at each time. Like the first dice roll I'm getting, let's say I got one. Second time I am rolling the dice, I'm getting, let's say, three, and so on. So this basically constitute a time series of a biased dice roll. And what I am looking for is, let's say I have 50, I have done this experiment 50 times. I want to project, I want to forecast the next 10 time steps. There's some background noise coming.
Sorry, sir.
Okay.
It is sorted, sir.
Yeah, thanks. So if, yeah, I was saying if the reference distribution is this, okay, the objective is basically to come up with like GBM forecast for the next 10 time steps in this particular case. Okay, so I have a time series up till 50 of a biased dice roll, and I want to forecast the next time steps. If I would have used the GBM distribution and I do Monte Carlo simulation, let's say 10,000 times, the distribution that I got would be log normal, okay, based on the mu and the sigma of the reference distribution. So this is nowhere close to the reference distribution, right? And this you can get a feel of it, you like quantify it using KL divergence. KL divergence is nothing but a way to quantify how different two probability distributions are. If KL divergence is zero, these two probability distributions would be exactly same. If the KL divergence is value is higher, the two probability distributions differ from each other. So the traditional GBM distribution KL divergence is 0.19. But if I use the entropy corrected GBM distribution, I have basically employed GBM, but I have filtered those trajectories using entropy to conform to the reference distribution. So in this case, I am getting a KL divergence of 0.02, which is a very good metric. Again, in the next case, if I roll that dice 500 times, okay, and I want to forecast the next 50 time steps or like next 50 outcomes. Basically, I'm looking for the probability distribution of the next 50 outcomes. So again, the KL divergence in this particular case using GBM distribution is way higher, okay, whereas ECGBM is again of similar level of accuracy when I had the shorter time series. And so on, if I have 5,000 dice rolls and I want to predict the next 100 or forecast the next 100, the entropy corrected GBM is still performing way better than the traditional GBM method. So now, since, as I explained before, I do a lot of algo trading as well. So I wanted to basically find out how this method would perform if I have to, let's say, simulated time series. Okay. So in simulated time series, what I have done is I have used a trend factor, which is like M is the slope of this line. And then I have also used sine function to give some oscillatory nature to this time series. And epsilon is again white noise. Okay, it's just a random error term. So I have these two, like one is the upward going time series and the other is the downward trending time series. In both these cases, I employed, so up till this particular point, let's say up till time step 80, I am basically using this up to 80 time steps, the probability distribution of the time series, and I'm using the GBM to forecast the next 20 time steps. Okay. In both these cases, the GBM forecast and the ECGBM forecast are like pretty much also explaining the trend. Like this is slightly upward trend, this is slightly downward trend. Okay. But the ECGBM prediction is basically capturing or quantifying the more like it's quantifying the more nuanced variations as well within the time series. You see, in this particular case, the ECGBM forecast, it also has some oscillatory nature here as well. So this is possible because GBM would have forecasted the next 20 time step based on log normality distribution, and which clearly this time series wasn't a log normal distribution. So if we continue to use GBM, we may end up getting inaccurate results. So next, I also work with gold versus US dollar market, where my objective or my interest is to come up with models where I can forecast the future gold prices. And if you guys follow the market, you must have seen in the last 1 month or 2 months, like the gold prices has shot up like crazy because of the inflation and interest rate policies in the US. Okay. So now, uh, in a typical like market, in the live market, there can be various factors. Okay. Like there can be macroeconomic factors like interest rate, how the GDP or the economy is performing, unemployment claims comes out every week, and all that factors are there which affect the market movement. Okay. Like it affects every market. But now what my thought process is, okay, all of these factors, if you keep aside, can I come up with a model that gives me the maximum information that is available within the time series, so as to so that I can make a more accurate guess? Okay. I hope you are trying to understand this. In a real market, there are various factors that are affecting the gold price. But can I come up with a model such that it provides me the maximum information that is available within the probability distribution of the time series? So that's where, if I had the assumption of log normality and I would have used GBM to forecast stock prices, I would end up, even though I am here getting the right trend, but again, ECGBM is giving you those variations as well. Okay. Again, this is not financial advice. So I wouldn't recommend you to just go out there and use it because there are so many factors affecting the market movement. Okay. But still, everything that you can equip with, you can equip yourself with that can provide you even little more information, you should be able to make a better guess. So that is where I am also like try to model gold versus US time series, and I see that the entropy corrected GBM, of although it may not tell you okay what's going to happen in the future, but still it's going to capture slight nuances that the traditional GBM method failed to capture. And why this is important, because even in different fields like option pricing or derivative pricing, GBM is also used heavily. So if they are considering underlying probability distribution to be log normal and it's not log normal, then you may end up in quite a bit of trouble. So it is very important that you consider what factors affect the market and what is the distribution and what are the assumptions of the model that you are trying to use. Lastly, I wanted to show a potential application of this particular method in the banking sector, or even at hedge funds. People want to estimate value at risk. Okay. What is value at risk? Value at risk basically gives you an estimate of the extent of potential financial losses within a portfolio in a certain time frame within a given confidence interval. Okay, I'll just highlight the steps that are involved in estimating value at risk using Monte Carlo method. There are other methods as well to estimate VAR, but using Monte Carlo, what you do is you define your portfolio. Let's say you have different stocks. Let's say you have Tesla, Apple, Microsoft within your portfolio. Okay, now you want to estimate within a time frame, like that time frame can be 1 day, 1 week, 1 month. So let's say within 1 day, what can be your potential financial loss within, let's say, 99% confidence interval. Okay, so to do that you use VAR. So first of all, you define your portfolio, you define all these things, you collect your historical data, and then traditionally people use GBM to simulate future stock prices. Okay, and then compute the portfolio return. So if you are simulating future stock prices, you can also get what will be your portfolio return, right, for each day based on this simulated future stock prices. And then someday you will get positive returns, someday you will get negative returns. So what, let's say you do 1000 Monte Carlo simulations. So you sort all of those portfolio returns, and then if you are interested in 99% confidence interval, so once you have sorted those returns, you look at the 1% of 1000 Monte Carlo simulation, which is 10th position. So in the ascending order, what is your worst 10th return? Okay, that would be your estimate of VAR. But this can be again problematic because again you have assumed log normality in the historical distribution. This can be problematic if historical data is not log normal, as you have seen in the Tesla case. Okay, and this is very common. Whatever, as a simple exercise, you can look at various stocks. Okay, you look at the historical distribution of the stocks and compare it with the log normal distribution, and you will be surprised to see that majority of stocks in the last few years haven't followed log normal distribution. But again, it depends on the time frame as well. If you consider 1 year, it won't be log normal. If you consider, let's say, 4 5 years, maybe it can be log normal. But as an algo trading enthusiast, I wouldn't be much interested in looking at 5 year data, historical data for my GBM to predict something that aligns with like 4 years in the past. So yeah, ECGBM can be quite helpful in this particular application as well. Again, now to conclude this
Hello.
particular talk. Hello.
Hi, Rishabh. I just wanted to ask something.
Yeah,
So,
sure, sure. Go ahead.
do you think it's just this 2 to 3 years that the data has been not been log normally distributed, and it will correct to being log normally distributed because it stems from the assumption that returns are normally distributed, hence the stock prices should be ideally log normally distributed. So do you believe this will eventually reflect in the markets over the next few years, and we will see the prices back to being representing more of a log normal distribution?
See, nobody can tell you what's going to happen in the future, right? But based on the last few years of uh, like events happening in the world, okay, if you starting from COVID, like you see all those events that are happening, that has given a volatility to the market that is way too much. At least in my experience, I haven't seen that high volatility when I analyzed the past data. Like if I consider 2000, let's say 12 to 2018, okay, when I analyzed that data, I did not experience the high volatility that I'm experiencing today. Okay. Again, in the future, the how the world is going to behave with so much of unpredictability, you cannot tell what's going to happen. So I don't know whether markets are going to follow the log normality again or not. Even if, even in the prior case as well, the log normality assumption is not fully followed, but it did not do much harm as well. But now, if you look at the Tesla's stock prices data and all that, like it's crazy. And if you have to find potential applications, you can also look at crypto data like Bitcoin and Ethereum and everything. No, I don't think they are going to follow log
Right.
normality assumption.
Right. They
Yeah,
don't follow. They are exceptional.
yeah. So again, if you want to use GBM or any other stochastic model, then that just make sure that whatever assumptions of that model is there, you are like conforming to those assumptions in the historical data as well.
Sure. Thank you, Rishabh.
Hmm. Okay, so to conclude, in this particular research, what I have shown is like uh, entropy serves as a measure of determinism within the distribution. Traditionally, entropy is thought of as a measure of randomness or uncertainty, but I just wanted to go in the reverse direction by using entropy as a means to tell me how much determinism I have within the probability distribution and the trajectories that I am basically appending to my historical distribution. So when I try to analyze the entropy, I feel that entropy can give me certain level of more confidence within the information content that I want to analyze within the historical probability distribution. And so in this particular approach, I have tried to manipulate this entropy concept by strategically adding the simulated trajectories from the GBM to the historical distribution, and then filtering from those simulated trajectories certain trajectories that conform to the underlying probability distribution. Also, we have shown the application in historical time series, like uh, in the case of biased dice roll, or even uh, value at risk, or just gold versus US dollar. And there is something extra information that I am extracting you if I'm using ECGBM. And this can also be used as a tool in enhancing maybe machine learning models as well, which are also heavily used for forecasting. So in the end, I just also want to acknowledge my professor, like who's Sabrik Ais here on the left. He is my advisor at Purdue University. And this work was done in collaboration with Professor Dominic. He is in Poland. And the funding, I also want to thank the funding agency, which is US Department of Energy, Office of Science. So thank you. If you have any questions, I'll be happy to answer all those.
Hi Rishabh. Just as a side note, I wanted to inquire like what instruments do you trade and
So I mostly trade in gold and forex, and like I've also recently started some options of like trying to build models for option trading. But yeah, and stocks, like stocks is also there. So yeah.
uh, do you find gold to be like commodities are a little bit uh, I'd rather say if they follow mathematics, they don't follow mathematics as such. I've read. So is that a challenging problem to you? Forecast trying to forecast gold, and what sort of
It is,
challenges do you
yeah.
feel are there?
Yes, it is quite challenging, I would say. But also one advantage with gold is that it depends on what is your uh, basically mindset in trading. Like, for example, if you want to build a model for long-term investment, or if you want to build a model for short-term trading, like I used to build model, or I also currently build model for trading just next 4 to 8 hours of forecasting, right? Like for example, want, if I'm working on gold, because the gold market is so volatile, okay, it is so oftenly affected by macroeconomic factors and all that. So within just few hours, it can make a very high movement, either in the upside or the downside direction. So it depends on the what kind of models you want to build for algo trading. Like either you are trying to predict what's going to happen, this can be one case, or the second case can be you are trying to build an algorithm that inherently does the risk management for you. Okay, like if you are building a good hedging strategy, that can be one option, right? But hedging strategy, I don't think would work on gold, because by the time your hedge kicks in, the gold has already moved quite a bit.
Right.
So
Right.
yeah, it
Gold
yeah,
itself, I
yeah,
believe, is a hedge against inflation mostly.
exactly. Like people use gold as a hedge against inflation. So it depends on what you are working on. So for me, I like volatility, because within few hours it can tell you, like if your model is good enough, it can give you decent returns as well. So but then again, it has its own risks as well. Yeah.
Right.
And
Right.
if
Thank
you
you for
guys
that.
are also interested, yeah, if you guys are also interested in collaborating, I can also like I am open to collaboration. Like we can work together on building models as well. But it will be more on the side of, like, since I am currently towards the end of my PhD, I can advise you guys. But we can build something together as well if you guys are interested.
Yeah, sure. That sounds great, Rishabh. Would love to connect.
Mhm. Mhm. So I had one question from you guys. In IITs, do you have like, is the quant finance a new department, or is it like you are doing it on your own?
We are doing it on our own as an initiative from our society.
So,
We have a minor that is offered in finance. You can
mhm.
pursue a separate minor in finance, but this initiative is from the Society of Finance, Economics, and Business.
Oh, that's really nice. That's really nice that in at least like from first year onwards, if you guys have exposure to all of these things, I think it is going to really help you. At least like if you even spend like 2, 3, 4 years, you by the time you graduate, probably you guys will have good enough exposure to different markets. Yeah.
Yes, sir. Basically,
Hello,
that is
sir.
our purpose, so that our students get exposure to quantitative finance starting from first year itself.
Mm.
So it's kind of senior junior
Mhm.
culture wherein they learn by learning from their seniors and working together.
Mhm. Mhm. Yeah, it's very nice. Mm.
Someone was asking me a question. Kindly ask.
Hello, sir. I'm Vijay. So I have two
Mhm.
questions. One is that I see that you have pursued your PhD in quantum computation. like how relevant is quantum computation right now in finance, and how how often is it used, and what are the prospects of quantum computation in finance? My second question is that I see that for this extensive research which you have done, you might have gone through lots of literature. So, what is your take on present research which is going in quantitative finance, and in which area is
So
most
what
of
is
the
the take on your?
research which is being held in quantitative finance right now? In
Sorry,
which
I
direction?
missed you. Yeah. Okay. Okay.
I mean, how is it going
So
to take
when
shape
it
in future?
yeah. So when it comes to quantum computing, so quantum computing is right now a very evolving field. Okay. And quantum computers, like there are few companies in the US, and now I think India is also heavily investing in quantum computing. There are few companies that, like IBM, for example, they have built their own quantum computers, and Google is also there, and there are other companies that are building quantum computers. But the quantum computers that uh, can be used for practical purpose, it's still few years we have to wait. Okay, because there are certain limitations right now. So now what companies are doing, like if you consider quantum finance as such, like in quantum finance, there are different aspects. Like for example, if you use Monte Carlo simulations, for example. So now you are basically looking for a quantum algorithm that can speed up the Monte Carlo process. So there has been a quantum algorithm. So this is now all theoretical, right? So there already exists a quantum algorithm that can do the same task that Monte Carlo does, like finding expectation value in a faster, like in fewer number of steps, not faster, in fewer number of time steps. Okay. So if I think, I don't remember, but if Monte Carlo like I think we get quadratic speed up by using the quantum algorithm over the Monte Carlo algorithm. But the problem with the current quantum hardware is that, let's say the classical hardware runs at gigahertz speed, right? So it can do so many calculations within 1 second. But quantum hardware, it runs on kilohertz speed. So the time it takes to process one calculation is way higher right now on quantum computer, even though it is going to take fewer number of steps to perform the same calculation. But let's say 10 years down the line, if somebody is able to build a quantum computer of gigahertz speed, then there's no match to, like, classical computer cannot even stand. But that is a long time, far in the future. So right now you can find, like, in quantum finance, this derivative pricing part can come. Portfolio optimization is there. Like, portfolio optimization is also a challenging aspect if your number of stocks or assets within your portfolio becomes very large. So that problem can also has an alternative solution using quantum algorithm. Okay, but again, the current scenario, like, they cannot be practically used. So it depends on what your interest area is. If you are interested in developing quantum algorithms, then you can develop for sure, but finding its application in real world at the moment is quite challenging. And second question was regarding the study material, or like the literature that is there, right? So in this particular research that I have showed you, like, I, to be very honest, there's not much literature that I've gone through here. What I have been working on in my PhD, like entropy. Entropy is a very simple concept, right? And how entropy is being manipulated, that comes from creativity. Like, my creativity lied in, like, basically using the reverse engineering part, like in maximal entropy formalism that I used, like, it is very prevalent in statistical physics. So I, as my PhD, I employed that maximal entropy formalism in quantum information. And while I was thinking on that, because I was also working in algo trading, somehow I just made the right connection that, okay, this, if I do the reverse part, I can come up with this particular thing. And to be honest, GBM was nowhere in the picture. I was just trying to use entropy for future market prediction. Then just now you all have access to chat GPT, right? While while working on these models, I was doing some, like, I got some you can say hints from chat GPT that okay, GBM is also used for forecasting stock price. So that connection, then I read GBM, like I read about GBM thoroughly in that particular case. And so I felt, oh, this assumption, it's not serving me. And GBM is very heavily used. So then I basically made that connection. Oh, if I use entropy, then I can basically improve GBM. So that's how I feel, if you just keep working and developing models based on whatever programming skills that you have, okay, and just maybe take a simple course or whatever you want to do and try to build models by yourself, not follow anybody, okay, that will help you more in the long run. Because see, if somebody is telling you that this model works, okay, then it would have worked at some point in the past, but right now that model is going to fail for sure. Because if the model would have worked, then he would not have been telling you, right? As simple as that. So it just, you need to come up with some novelty that you can exploit.
Yeah, thank you.
So if you guys don't have any more questions, then probably we can end. Chandan.
Thank you so much, sir. On behalf of the Quant Club, IT Bhubaneswar, I express my heartfelt appreciation for Mr. Rishabh for hosting such an insightful session. It was definitely a session which will help students to explore different research areas. I also extend my gratitude to all the participants for their active participation in the webinar today. I hope this session not only helped in expanding your knowledge in the aforementioned topics, but it will also serve as a networking opportunity to connect with like-minded people. We at FEBS aim to keep on hosting such informative sessions from time to time, and we also post informative content regularly, so make sure to follow us on social media. Thank you so much.
Thank you, guys. Thank you.
ஆமா என்னமோ யூடியூப்னு ஆரம்பிச்ச கணக்கு உனக்கு